am one of the lambs that Wall Street has shorn. When I was a little girl, a patron of art left me $1 million for my musical education. But I thought I couldn't live on the income from $1 million. So I asked all my rich friends for tips on the market. They gave them to me, and I lost my million. Now the only thing I have left is this chinchilla coat of mine. From now on, my hands are off the ticker and on the piano keys. But if you're lucky enough to have $1 million, hold everything and don't play the market.
All right, folks, this will be a different show. We're not going to cover the stock market activities per usual. We will resume doing so starting tomorrow. But in this video, I want to discuss an important subject, the misunderstanding and confusion regarding this economy and inflation. So let's dive right into it. In focus tonight, the truth about this economy and inflation, because many out there are confused. Supposedly, we have a hot economy, a great economy, a recovering economy, with the highest stock market ever, with labor shortages and wages rising higher. But we also have inflation, supply chain woes, and on top of that, we have the lowest consumer sentiment in history. Why? What's going on with the distortion and the divergences in this economy? Let's back up for a second here. Over the weekend, my wife was watching Bill Maher, which is, I'm not a fan of, by the way. I find his sense of humor to be dull. After all, you have writers writing your jokes for you, but somehow you get to cash in $60 million a year. But the writers who are writing the jokes don't. Anyhow, my wife convinced me to sit down and watch the show with her because Kevin O'Leary was on, and she said, "Isn't Kevin O'Leary the guy from Shark Tank? He's a stock market guy. You'll probably be interested in watching this." And I said, okay, I'll sit down and experience the torture. And I was right, because O'Leary did not contribute anything at all. Bill Maher had a lot of questions for him regarding the economy, and O'Leary did not provide anything helpful at all. He was playing with his phone, and perhaps the most important statement that O'Leary said is, in response to Bill Maher's question, "Do rich people understand the economy better than the rest of us?" And Kevin O'Leary responded by saying no, and he provided proof to his answer by illustrating his lack of knowledge about the economy and the stock market, even though he is supposedly a quote-unquote rich guy. Bill Maher asked about, why do we have somebody like Elon Musk worth over $300 billion? Why do we have such huge wealth inequality in this economy? Why are we seeing low consumer sentiment, inflation, and supply chain woes when the economy is supposedly recovering and we have an all-time high stock market that continues to go higher and higher and higher? And of course, Kevin did not answer the question. Kevin said that Elon Musk is worth what he's worth because he's a genius. And then he shared a little bit of truth by saying that we have printed more money than ever before, but he did not elaborate at all. And then he went on to say that people should not be paying taxes, the rich should not be paying taxes, Elon Musk should not be punished by paying more taxes, yada yada yada. Did not answer anything at all, left Bill Maher and his audience confused. So I'm going to resolve everything here, and I'm going to explain everything that's going on with this economy in simple terms for you. There are three concepts that you have to understand. Number one, excess speculation. Number two, risk. Number three, inflation. And they all tie in together. And I will give you examples from history for all of these terminologies. Excess speculation, risk, and inflation from 1929, the 1970s, and the financial crisis in 2008-2009. Let's start with excess speculation. In the aftermath of the financial crisis in 2008-2009, the economy was destroyed. We were heading into the Great Depression, perhaps even worse than the Great Depression, the biggest financial crisis in our lifetimes. The Federal Reserve decided to rescue the economy by initiating a so-called quantitative easing program, which means reducing interest rates pretty much down to zero and therefore allowing companies to borrow money pretty much risk-free to climb from the hole of the financial crisis. The Fed also initiated purchasing programs for various assets, including bonds and mortgage-backed securities. The goal from these purchases is to support the equities and real estate markets. In essence, by buying billions of bonds and mortgage-backed securities, the Fed acts as a traffic cop and says, you know what? If you buy bonds, you're not going to have any return for your investment because we're buying bonds and yields have an inverse relationship. When bond prices go higher because somebody's buying the sugar daddy, in this case the Fed, yields go down. Now, do you want to invest in bonds when you know that yields are going to continue to go down? When you adjust to inflation, you're losing money if you buy bonds. So what else are you going to buy? The answer is when the Fed acts as the traffic cop saying stay away from risk-free and minimal risk investments, then the only open avenue for investing becomes risk-on investing, meaning real estate, but specifically the equities market. So every penny from pension funds, from retirees, from mom and pop investors, from institutional investors, from states, from localities, every single penny flows into risk on, meaning the equities market, and that recovers stock market prices after the crash, and it helps those companies to recover, create more jobs, and therefore the economy goes back on its feet. Here's the problem. Every so-called emergency for Wall Street never ends because we are here in 2021 and the Fed is still enacting the same rescue policies from the financial crisis of 2008-2009. The Fed initiated more rescue policies after the COVID crash in 2020. Those policies are still here. They only started tapering this month. So the Federal Reserve remains so-called accommodative to Wall Street via pumping the equities and real estate markets higher. Now, who owns the majority of the equities and real estate markets? The answer is the rich. Matter of fact, 89% of the equities market is owned by the 1%, the rich. Only 11% is owned by the population, the bums, the regular folks. And therefore, this kind of policies are biased toward benefiting the rich and hoping that some will trickle down to average folks, hoping that companies will create jobs and also benefit regular people. It's a top-bottom approach, and therefore it is heavily tilted toward benefiting the rich, the corporations, but not average Americans. And therefore, after more than a decade with these policies, we have the largest income and wealth inequality gap in this country's modern history. And then you have to understand another concept called excess speculation, which is a byproduct of these policies from the Fed. Let's talk about Elon Musk, for example, the richest man not just in the world, but in history, the first human being to achieve a fortune worth over $300 billion. How is that possible? Did Elon Musk create something tangible that reflects this rise in wealth in a short amount of time? You read headlines like this: Elon Musk is so rich, he can buy every sports league in America, not just a sports team, but the entire league. He can also buy ExxonMobil. He's worth more than ExxonMobil. One individual is worth more than the largest oil company in the world, second to Aramco. Matter of fact, Elon Musk's wealth is more than the GDP of Finland. It is more than the GDP of his native country, South Africa. How is this possible? Does it make sense at all? Well, what did Elon Musk create? Where does his wealth primarily come from? The answer is Tesla. This is the brand that he created, and this is the main source of his wealth. Tesla is now worth about $1 trillion as a company. Matter of fact, it is worth more than the automotive industry combined, meaning Tesla's worth not just more than Toyota, but more than Toyota, GM, Ford, and every other auto manufacturer combined, and then some. Again, it must be a great company, Tesla, right? it must produce a lot of money to justify this valuation because understand this, Elon Musk is not that rich. He doesn't have $300 billion in the bank account or under the mattress. His wealth fluctuates with Tesla's stock price. When the stock price shoots up higher, inflating the value of Tesla as a company, then Elon Musk owns a piece of that company and his wealth also expands as a result. But all of these are paper gains until somebody hits the sell button, and then the fake wealth becomes real wealth because the numbers that you see in the screen, when you hit the sell button, these numbers become real dollars. So Elon Musk is worth $300 billion now, but if the stock price of Tesla crashes by 50% overnight, then also overnight Elon Musk will be $150 billion poorer. So what is behind the rise of Tesla's stock? Why is it worth more than the entire automotive sector combined? The market cap of Tesla, for example, is $1 trillion, way bigger than Toyota's $252 billion, or even VW, which is worth $142 billion, General Motors worth $92 billion, and Ford is worth $78 billion. Now, you could say, well, perhaps Tesla produces more money, more revenue. The reality is, last year, Tesla produced $31.5 billion in revenue versus Toyota's $257 billion in revenue, or take, for example, VW's $254 billion in revenues in 2020. Likewise, General Motors produced $122 billion in revenues, and Ford, lastly, produced $127 billion in revenue in 2020. What's going on here? If Tesla produces a fraction of the revenue of these companies, then why is it worth more than all of these companies combined? Perhaps Tesla sells more cars. Perhaps that's what's going on here. Well, here is the reality. Tesla produced about 500,000 cars last year. Toyota, on the other hand, sold 9.5 million cars last year. VW sold 9.3 million. GM sold 6.8 million. And Ford sold 4.2 million cars in 2020. So what's going on here? Does this make sense at all to anyone? A company that produces a fraction of the revenues and the cars of these companies, Toyota, VW, GM, and Ford. How come that this company, Tesla, is worth more than all of them combined? The answer is excess speculation. Matter of fact, Tesla is only a $1 trillion worth of speculation, the most dangerous phase of speculation in human history. If you thought that was crazy, we had another electric vehicle company called Rivian, which is a concept company, meaning they don't have any product yet. They have not sold any product yet, but the company IPO'd last week in the stock market, and it is now worth more than General Motors and more than Ford. Matter of fact, it is worth more than VW. Again, a company with zero product, nothing to sell, no revenues, no profits, but somehow the company is worth more than VW that sells millions of cars every year and produces billions, if not hundreds of billions in revenues every single year. How is this possible? The answer, once again, excess speculation. Matter of fact, EV startups are now worth more than the entire automotive industry combined. Perhaps they're producing more EVs. Perhaps they're producing more cars than traditional automotive makers. The answer is no. They produce a fraction of what traditional automakers are producing. So what's going on here? The answer, once again, excess speculation. And perhaps this could all be explained if we revisit the 1920s, an era of excess speculation.
The 1920s is boom time in America. Money flows and oil wells explode. Though farmers are struggling, cities expand. Skyscrapers go higher than the stock market. Aspirations run wild for cars and suburban housing projects like Hollywoodland. By 1929, more money is spent on advertising than on education.
We got a little carried away with consumerism and capitalism, and it bit us in the butt.
The boom is built on credit. In 1929, $6 billion of goods are bought on credit. But 80% of Americans have no savings at all. Some stocks are valued at 50 times what they're really worth. A giant bubble just ready to burst. By October 1929, the inevitable happens. The stock market loses 12 times more money in 3 weeks than the U.S. government uses in a year.
The entire country could have gone down, and almost did, from an economic point of view.
For a year after the stock market crash, America's economy teeters on the edge of the abyss.
Households use debt for 80% plus of their purchases. And the hottest item at the time was radio. People took loans to buy radio, but the excess speculation and spending did not stop there. People started to take out loans to invest in the stock market because stocks were surging higher and higher and higher. And it caught the public's attention. And when the public participates in the stock market, it is always going to end up in a disaster because when the public participates, they don't invest, they gamble. So people borrowed money on margin to invest in the stock market. And when the stock market took a U-turn and started to crash, a phenomenon called margin calls started to hit. All of a sudden, if you took loans to buy a stock and the stock goes down, you gotta have some money in your account to cover for that loan. If you don't, then your broker will have to sell other stocks in your portfolio to raise the cash needed to cover the margin for your loans. And this is exactly what happened in the great stock market crash of 1929.
Distressed selling on the stock exchange, and we have held a meeting to discuss the situation. We have found that there are no houses in difficulty, and margins are being maintained satisfactorily.
Grandfather and many others felt that the worst was over, but they were very, very wrong.
Over the weekend, the bankers' interventions seemed to have worked. Trading on Friday and Saturday was calm and uneventful. President Hoover also tried to steady nerves by repeating a mantra that has been used during market crashes many times since.
The fundamental business of the country, that is production and distribution of commodities, is on a sound and prosperous basis.
But in the offices of the financial district, there was total chaos.
One of the things that we forget is how primitive the technology was. So many stocks traded on October 24th that it took 4 hours for the ticker to print all of the stock trades after the market had closed.
The ticker, hopelessly swamped, fell hours behind the actual trading and became completely meaningless. All night long, the lights blazed in the windows of the tall office buildings, where margin clerks and bookkeepers struggled with the desperate task of trying to clear one day's business before the next day began. They fainted at their desks. The weary runner fell exhausted on the marble floors of banks and slept.
On Monday, with stock tickers running out of tape, panicking investors desperate for the latest share prices jammed the telephone lines between New York and other major cities. For the first time, many speculators were discovering the downside of easy credit and buying on margin.
A fairly significant number of people who were buying stocks in the 1920s were buying it with borrowed money. And of course, the wonder of buying stocks with borrowed money is that the gains are tremendously accelerated and magnified on the way up, and then of course on the way down the entire machinery is thrown into reverse and the losses are also magnified.
What do we have now? We have the highest margin debt level in history. People are using margin to YOLO stocks, be it IPOs, be it EV companies, be it any sexy, cool name that they think it's going to be the future. They're borrowing money to invest in these names, pushing the valuations out of whack. All of that is excess speculation, not reflected by the fundamentals of these companies. Yet the owners and the insiders in these companies enjoy the rise in wealth due to the rise in stock price due to excess speculation by the public. The rich, of course, they get to dump at the top, locking these gains. The stock crashes on the top of the heads of the speculators. This has been the story all along of public participation in the stock market. It always ends in a tragedy. And of course, nobody knows what triggered the crash in 1929, but rumor has it there was a rich man. Nobody knows the identity, but by all accounts, it is Joe Kennedy, the father of JFK. This is yet another criminal organization, but anyhow, he was walking the streets, got his shoe shined, and the shoe shine boy was giving Joe Kennedy stock market tips. That was the moment when this rich man, be it Joe Kennedy or any other guy, realized that it is time to dump his stocks and get out of the stock market because it became a vehicle of speculation, divorced from fundamentals, meaning it is an opportunity to lock these gains, watch the market reverts back to its fundamentals and true valuations, perhaps overdo that crash so stocks can become cheap again, and they use that cash to buy the dip in the stock market and they ride the ride higher once again. But the public loses their money and they don't get to participate again. It always ends in a tragedy, and the reason is the excess speculation. So what enables excess speculation in the stock market? For that, you have to understand the concept of risk and inflation. And for that, we're going to revisit the 1970s and the financial crash in 2008-2009. To understand the concept of risk and inflation, first you have to understand the concept of money supply. Money supply, simply put, is the money being printed by the central bank, the Federal Reserve. And every time throughout history, when we see excess money printing, when we see growth in printing and the money supply, there is always a delaying effect before we see inflation being born in the economy. And as you can see, black is the money supply, red is inflation. And pretty much every time we have a spike in black in the money supply, that is followed by a spike in inflation in red. And the spike in inflation usually prolongs. Why is that? Here comes the concept of risk and inflation. Risk is a byproduct of excess money supply. When the Federal Reserve prints money out of thin air and floods the financial system with liquidity and cash all over the place, this cash doesn't disappear in a black hole. This cash is used by consumers to buy goods, and therefore the cash floats all the way up to the corporations. Likewise, this cash printed out of thin air is also used by the public and institutions to invest in the stock market, and therefore it pushes equities prices higher, perhaps beyond reasonable valuations, and hence the concept of risk. Excess money equals excess risk. Every economy at every stage has to have some degree of risk, represented by a stack of matches. If the stack is small, controllable, and reasonable, then this is a healthy economy. But when the stack becomes bigger and bigger and bigger due to more money flooding the system, and that money has to chase risky assets, be it stocks, be it commodities, be it real estate, then the stack of risk becomes bigger and bigger and bigger, and hence the risk for the economy. So risk is a byproduct of money printing, the money supply. Then we have a byproduct of risk, which is inflation. Think about inflation as a natural remedy to the excess risk in the economy. As people start to speculate more in buying stocks, buying real estate, buying products, goods, and services, prices go higher naturally due to the excess demand and risk in the economy. And inflation becomes the natural remedy. Prices start to go higher and higher and higher to reduce that desire for risk and excess demand lower and lower. When prices go higher, fewer people can afford these goods and services. When stock market prices go higher, fewer people can participate in the stock market because it is too expensive. When real estate values go higher via inflation, less people are able to afford homes and real estate assets because prices are at a budget. The problem is when the tap of money supply continues to go on, then that stack of risk will continue to get higher and higher and higher. And therefore, inflation, the natural remedy of risk, will also continue to go higher and higher and higher, and perhaps at some point lead to hyperinflation or even stagflation, as we've seen back in the 1970s. And therefore, there are two remedies to this excess risk in the economy. Either you let inflation take care of it, and this is an extremely dangerous approach. that could lead to hyperinflation or even stagflation in the economy. And therefore, the other remedy to reduce that stash of risk and excess speculation and excess demand in the economy is via monetary tightening, adjusting the source of inflation. Money supply is the source. You either got to cut money supply or raise interest rates higher, or perhaps both. They're essentially the same thing after all. Because in the 1970s, everybody remembers the great inflation in the 1970s, but the truth is, inflation started in the late 60s due to the excess money supply and money printing by the Federal Reserve to finance the Vietnam War. The chickens were always going to come home to roost, and inflation started to spike up higher in the 1970s. The CPI, the Consumer Price Index, was surging higher, and this is the CPI, by the way, which doesn't reflect the true nature of inflation. And of course, throughout the 70s, presidents did not understand or perhaps refuse to understand to control inflation for real. You got to go to the source. And the source is always the monetary policy of the Federal Reserve, the money supply, and the easy money policies. Yet these presidents refused to do anything regarding the monetary policy because they wanted the easy money policies around to benefit their donors and their benefactors, Wall Streets and the likes. And instead, they issued austerity measures targeting regular folks via the fiscal policy, instead of targeting Wall Street and the corporations via the monetary policy, which is the source of inflation. For example, Nixon refused to tighten the loose money policy from the Fed. He actually wanted the Fed to double down on the easy money policy. And instead, Nixon, the Republican, issued price control measures, the likes of Venezuela, also known as the Nixon shock, and of course changed the backing of the U.S. currency from gold to the petrodollar. And that worked for a little while. Price controls drove the CPI down, and then it came back again. Why? Because fiscal policies are not the source of inflation. They can target inflation for a little while, but so long as the tap still open from the monetary policy and the money supply continues to go on, that inflation will come back again. And this is exactly what happened during the Ford administration. And President Ford enacted more austerity measures known as whip inflation now. And that worked for a little while, and then inflation came back. And a new president was elected, Jimmy Carter, which people blamed for inflation, but the truth is he inherited inflation. He had nothing to do with this inflation. Matter of fact, President Carter also enacted conservative policies such as reducing the size of government, reducing the salaries in government and pay, and also introduced austerity measures for people by urging Americans to use less electricity and drive less, etc., etc., etc. That did not work either. Why? Why is it that the fiscal policy has no control in reducing inflation? And all of those austerity measures only reduce the quality of life for average Americans. To answer that question, I already answered it for you, because the source is the monetary policy. The source for inflation is the monetary policy, not the fiscal one. But if you don't believe me, perhaps you believe legendary economist Dr. Milton Friedman, who taught us that inflation is always a monetary phenomenon.
The reason we have inflation in the United States, or for that matter anywhere in the world, is because these pieces of paper and the accompanying book entry, or their counterparts in other nations, are growing more rapidly than the quantity of goods and services produced. The truth is, inflation is made in one place and one place only, here in Washington. This is the only place where there are presses like this that turn out these pieces of paper we call money. This is a place where the power resides to determine how rapidly the amount of money shall increase. What happened to all that noise? That's what would happen to inflation if we stopped letting the amount of money grow so rapidly. This is not a new idea. It's not a new cure. It's not a new problem. It's happened over and over again in history. Sometimes inflation has been cured this way on purpose. Sometimes it's happened by accident. During the Civil War, the North, late in the Civil War, overran the place in the South where the printing presses were setting up. where the pieces of paper were being turned out. Prior to that point, the South had had a very rapid inflation. If my memory serves me right, something like 4% a month. It took the Confederacy something over 2 weeks to find a new place where they could set up their printing presses and start them going again. During that 2-week period, inflation came to a halt. After the 2-week period, when the presses started running again, inflation started up again. It's that clear, that straightforward.
Matter of fact, Dr. Friedman did not believe in supply push inflation. So when you hear, oh, this crisis that we're having right now of inflation is due to the supply chain, that supply chain has been disrupted. If the supply chain goes back on its feet, problem solved. We're not going to have inflation. Baloney. There is no such thing as a supply push inflation, also known as cost push inflation. The source of inflation is always the excess demand, aka monetary inflation, due to the loose money policies.
No, inflation is a national phenomenon produced by monetary policy and other policies within the countries.
Recently, we've heard that the inflation currently experienced in this country won't respond to monetary restraint because it's cost push inflation and not demand pull. What response would you have to that analysis, if any?
It's another example of the people who produce the inflation trying to find scapegoats for their own deficiencies. Of course the inflation will respond to monetary restraint. There is no such thing as cost push inflation, except in the form of the delayed effect of monetary inflation. If you have a monetary inflation that starts to push up prices, it tends to hit retail and wholesale prices first, the prices you and I pay. It's only later that it works its way through costs. But then costs fall behind prices, and there's a make-up period. And during that period, you have what looks like cost push inflation. But there has never been an inflation in history that didn't respond to monetary restraint. If you look at American experience, it responded to monetary restraint. If you take that roller coaster I was telling you, on each occasion, the slowdown in the rate of inflation was preceded by a slower rate of monetary growth.
So when you see these images and videos of ships stuck at ports, not being able to unload all of these goods to reach consumers, and you hear on TV, oh, this is the supply chain being disrupted. What are you talking about? Absolutely false. The supply chain by nature, COVID or no COVID, is designed to respond to the demand. It is designed to respond to money. If there is demand, the supply chain expands to accommodate that demand because no supplier would say, you know what, no thanks, we don't need money. We're just going to shut down. The problem in this economy is due to the excess demand and excess speculation fueled by the loose monetary policy of printing money out of thin air, trillions and trillions and trillions of dollars. And it will not stop until the Federal Reserve put a stop to the loose money policies. Simple as that. It is due to the delusional nature of the current creatures leading the Federal Reserve, who believe that we can have an a la carte kind of inflation, where you pick the good part and you spit out the bad part to aid the economy to recover from the COVID-19 crisis. The problem is, it doesn't work this way. If you want inflation, you're gonna get inflation. The good, the bad, and the ugly. Here's Dr. Friedman once again.
Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first. The bad effects only come later. That's why, in both cases, there's a strong temptation to overdo it, to drink too much and to print too much money. When it comes to the cure, it's the other way around. When you stop drinking or when you stop printing money, the bad effects come first, and the good effects only come later. That's why it's so hard to persist with the cure.
Remember, back in the 70s, the CPLI says we had periods of low inflation, where inflation responded to the fiscal policies and the tightening and the austerity measures from Nixon, Ford, and Carter. In reality, however, consumer prices continued to rise higher and higher and higher. And some of you might remember the scenes at gas stations running out of gas. And of course, back then, they wanted to blame it on some boogeyman from foreign countries. And they blamed the rise in gas prices and the shortages on the Arab embargo in the early 70s. The truth is, by the late 70s, the Arab embargo had nothing to do with gas prices surging or the shortages of gas. Gas prices were surging higher due to inflation, and the source of inflation primarily is the monetary policy by the Fed. So finally, President Carter realized that the austerity measures are not going to help, and the country will head into stagflation, a massive period of higher prices, and a slowing economy. President Carter decided to make the decision by allowing an American hero, legendary Fed Chairman Paul Volcker, to become the head of the Federal Reserve. And Paul Volcker did the right thing by tackling the money supply, by tackling the loose money policy, by raising interest rates, and that magically solved the problem.
President Carter found himself on the defensive because inflation was becoming very unpopular.
Inflation is our friend.
And that's when Carter appointed Paul Volcker.
When I was appointed by Jimmy Carter, he was kind of up against it. It was a very difficult period. I told him we were going to have to adopt tighter policies, and I felt very strongly about the independence of the Federal Reserve, and that's the way I thought we should act.
Burns said in a speech after he left the office, we knew, meaning we central bankers, that we had to reduce money growth back in 1964 or we're going to have inflation. And he lists all the reasons why he couldn't do it. It was that meeting that Paul Volcker left to do what Burns said couldn't be done.
People don't like to raise interest rates. It's not very popular. And there was some resistance and fear of creating a recession and so forth.
It was a close thing for Volcker even to pull it off internally. He had a substantial battle within the Federal Reserve.
Volcker had tried to get the Fed governors to nudge interest rates upward, without success. So he tried a different tack, persuading them to focus on controlling the money supply. It was a sleight of hand, because the two are essentially the same. But it was a politically palatable tactic, and it worked.
And when he slowed the money growth rate, predictably, the interest rate went way up.
Neither he nor I nor anyone else had any idea of how high the interest rate was going to be.
8% to 9% to 10%.
15%, 18, 19, 20%.
21%. Really the highest levels in American history.
He told me, I never thought we'd have to go to 20%. But he did. That took courage.
Paul Volcker was villainized for his inflation suppression.
It was a very tough period. And there's a lot of opposition, and no doubt about it.
Of course, there is a price to pay here. Jacking interest rates higher, tightening the monetary policy, could produce and will produce, at this stage that we're in right now, it will produce a recession, sometimes prolonged recession. But this is the remedy needed to avoid the dire scenarios of hyperinflation or prolonged stagflation. Now, let's move on to the financial crisis of 2007-2009, because so far we talked about the 1970s, how to solve the problem of inflation. You can do it manually, the Volcker approach, by raising interest rates and tightening the monetary policy, and that will work. There is another approach, perhaps a more dangerous approach, which is the approach of 2008-2009, aka the financial crisis. Leading to the financial crisis in 2007 in particular, the Fed started to decrease interest rates and becoming more accommodative to Wall Street, aka the loose money policies, which produced inflation, by the way. Inflation started to rise higher, and some of you might remember gasoline prices, crude oil prices trading above 100 a barrel, and then everything came down crashing. So what happened in the 07-08 scenario? Let's go back to our example of risk and inflation, the stack of matches. Inflation is the natural remedy of excess risk. In 2007, we had a lot of risk, specifically in the housing market, and therefore inflation was born to burn some of these matches and reduce the stack of risk. The problem is, sometimes you have a so-called hidden accelerator within the stack of matches. When that hidden accelerator catches up on fire, it blows up the whole stack, and the economy dives down into a depression. And this is exactly what happened in 2007 2007, 2008, leading to the 2009 crash. The hidden accelerator was the excess speculation in the housing market, the fugazi mortgages, the junk-rated mortgages that were trading at the time. But when you bundle them together, they became tradable assets with acceptable credit rating. But underneath all of that stack, when you grab each mortgage individually, they're actually junk-rated. But people bought them, people invested them. They were also known as CDOs. And that was the hidden accelerator. The moment it lit up on fire, it blew up the entire economy, and we were almost going to head into depression, the Great Depression 2.0. And then the Fed came to the rescue by enacting a looser monetary policy, by reducing interest rates to zero, pretty much. The bailouts, the assets buying, all of that rescued the economy. And back then, the Fed had room to loosen. Right now, where we stand right now today, we are already at the loosest policy ever. You cannot go lower. You can go to negative rates, but that comes with substantial risk of devaluing the dollar, and therefore the so-called reserve currency of the world becomes dog shit, and therefore the United States of America becomes dog shit. Keep that thought in mind. We're going to revisit it by the end of this segment. But one of the criticisms about this explanation of inflation, wait a minute, bro. The Fed has been printing money and doing QE since the crash of 2009. And we did not have inflation until now. How do you explain that? Think about it as an indicator that we use a lot in this channel in our charts analysis. It's the MACD indicator, just for illustration purposes, of course. When the crash happened in 2009, we were at the bottom of the MACD indicator, trading in the red in suppressed levels. The QE, the easy money policies enacted by the Fed in 2008-2009, were intended to rescue the economy back into positive territory, and therefore it did not produce inflation because the economy was already dead. We were just reviving that economy from the dead. At some point, the economy stands on its feet and starts reading at a positive reading on the MACD above zero. This is, of course, just to illustrate things for you. When the economy starts to trade above zero on the MACD indicator, and there are several elements dictating what constitutes a positive economy on a MACD indicator, this is, of course, all hypothetical and for simplification purposes. But we have the unemployment rate, we have corporate earnings, we have the GDP, the labor participation rate, consumer spending, consumer credit, a lot of things that dictate what is a positive economy versus a depressed economy. We reached that positive economy level at around 2018 under the Trump presidency. The unemployment level was the lowest in history, and therefore when you start printing money when the economy trading in positive territory, you produce inflation due to the excess. It is not needed, and therefore any accommodation, any money supply becomes excess, and therefore excess risk, excess speculation, which produces inflation. You're not going to have that when you have a depressed economy right after a crash, a historic crash in 2009. So printing money in 2009, 2010, 11, 12, that was all designed to rescue the economy, and therefore did not produce any inflation. But money printing in 2018, for example, did not make sense at all. Easy interest rates policies did not make sense at all in 2018, and they actually started to produce some inflation, and therefore the Fed started to raise interest rates in 2017, but most notably in 2018. And what happened then? The market crashed right away, and the president at the time, President Trump, started to attack Fed Chairman Powell, who he appointed, by the way. Why would you tighten the policy right now? Why would you reduce the money supply and increase interest rates when we don't have inflation? And the Fed's response is, we have to be proactive, not reactive in our policies. The Federal Reserve was intended to be proactive, to prevent inflation before it happens, not wait for it to happen and then respond. Of course, Fed Chairman Jerome Powell folded under the threat of Donald Trump, and he decided to back up and say, you know what, we're going to reverse all of these increases that we have enacted in interest rates. We're going to continue the loose monetary policy. And guess what? The stock market reversed right away and traded to all-time highs in no time, therefore benefiting the wealthy. Once again, fast forward to, let's say, January or even February 2020, before COVID, the conversation started to heat up again. Inflation is going to rise. We're seeing excess risk here. The loose policy by the Fed, by lower interest rates and money supply, will cause a lot of risk, which will cause inflation, and we're going to revisit that problem again. And guess what? COVID happened, the stock market crashed, the economy crashed, and the Fed said, whoa, 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 whoa. you know what? We're not only going to keep the loose policy, we're going to double down. We're going to cut interest rates to zero, or we're going to start buying assets, corporate bonds, etc. Or we're going to usher the tsunami of money supply, trillions and trillions and trillions of dollars. By certain estimates, the economic crash and subsequent lockdowns of the economy cost roughly $800 billion. That's all what we needed to resolve the problem. Instead, the Fed added to the balance sheet over $4 trillion. Again, all of that money printed out of thin air, it goes into buying certain assets, certain bonds, mortgage-backed securities, etc., etc. A lot of that money goes into fiscal spending, stimmies, etc. The public uses that money for what? Buying stuff, and the money floats all the way up to the corporations that you're buying from. Also, that excess money goes into chasing assets, including stocks, including commodities, and therefore we see these stock market valuations out of whack. Stocks trading all-time highs. They only go higher and higher and higher because all of that fake money, trillions and trillions of dollars, has to chase something. And for now, it chases the stock market and the real estate market via excess speculation once again. So you see the headlines, Americans are paying more for groceries, your Thanksgiving dinner is going to cost more, gasoline prices, the poster boy for this inflation, and everybody's confused. What's going on here? The economy is great, we got money. This is exactly the problem. The excess risk, the excess liquidity in the system, producing inflation, which is the natural remedy for the excess risk and speculation in the economy. And of course, the geniuses in the media, Wall Street, your beloved economists, nobody understands what's going on. Inflation is happening due to COVID. Inflation is happening due to the supply chain shutdowns. Baloney. If the Fed tightened the loose money policy right now and raises interest rates right now, yes, the stock market will crash, the real estate market will crash, but inflation, poof, gone. But again, don't expect any rationale from your beloved media, politicians, or Wall Streeters. Instead, they're blaming boogeymen from overseas. For example, they blame the rise in oil prices on countries like Saudi Arabia and Russia. They're responsible. They're single-handedly responsible for this inflation. And if they start flowing that oil, inflation will be gone. Again, bullshit, because the source of inflation in oil and gas prices is not due to the lack of supply. It is due to excess speculation, fueled by the loose monetary policy by the Federal Reserve. And I said this, describing Russia and Saudi as bad actors because they're not reducing the price of crude and gas by lifting supplies is a gross sense of entitlement. Why would these countries work against the national interest of their economies to rescue failed policies in the US and the EU? Of course, we have this obsession with green energy, even though it's not so green, by the way. Lithium is depleting the water resources in Chile and Bolivia. Cobalt mining for electric vehicles and phones is done via using child labor in the Congo Republic, and the mining of nickel, an important element in electric vehicle batteries, is threatening the environment in Indonesia, for example. The coral reefs turning water into red due to the pollution, threatening wildlife, like the orangutan, for example, to extinction. But nobody talks about that. It's green energy. It's a form of environmental colonialism. In reality, you want clean air in the US and EU, but you want to export the pollution to poorer countries. But regardless, the point here is the rise in oil prices is not due to foreign boogeymen holding the supply of oil. It is also not due to the policies from the Biden administration. Yes, they have an impact, a psychological impact of expectations. With this obsession of green energy, oil and gas will not be rewarded and it will be punished, matter of fact. And therefore, this is impacting the future expectation of domestic supply and pushing prices higher via speculation once again. Excess speculation, not due to a lack of supply or certain countries holding the supply of oil. Not true at all. Matter of fact, the domestic supply of oil, the average in 2019, pre the Biden administration, was about 12 million barrels. We're now only 10% below that average. Only 10%. Are you saying that the massive surge in gas prices due to 10% reduction in domestic supply doesn't make sense at all? The US remains one of the world's largest producers of oil and gas. Yet prices continue to climb higher and higher and higher. And they say, don't blame Biden for high gas prices. I say partially right because, mechanically speaking, fiscal policies have nothing to do with inflation. Very little control of inflation. The source of inflation is always monetary. The fiscal policy can impact the psychology and enhance the speculation going on, but fiscal policies are not the source of inflation, and certainly they're not the remedy. Matter of fact, shale oil output in the U.S. is at the highest levels since the beginning of the pandemic. When we look at the shale oil production in the U.S., it is matching 2019 levels. So all of this fallacy of, oil prices are rising higher because we shut down the supply, not true. All of those who say oil prices are rising higher because OPEC is holding the supply, not true. All of those who say oil prices are rising higher due to the supply-demand dynamic, not true. Yes, the demand is surpassing supply, but not by a lot. A matter of fact, the black market, meaning the Venezuelan, Iranian, and Libyan oil, is making up for the majority of reduction in supplies from OPEC, the US, and other countries. Matter of fact, we have revisited all of these questions back in 2007, when oil prices reached over $100 a barrel. The EIA, matter of fact, published a paper asking question, why oil prices so high? And they gave a list of explanations. None of them are true. All baloney. They said the demand is too high in China. Garbage. The supply is low from OPEC. Garbage. The bottlenecks in refining. Garbage. So what is the real reason for gas prices surging out of whack? If it is not the demand and supply dynamics, if it is not the fiscal policies from the Biden administration, if it is not OPEC holding supply, if it is not Putin holding supplies, why are oil prices surging out of whack? We go back to where is excess supply of money, there is excess risk. And where is excess risk, there is inflation. The real reason behind the rise in oil prices is speculation, as I told you before. Matter of fact, take a look at this headline from the Wall Street Journal. Crazy bets on $200 oil invade the options market. If you are watching the options market and futures like I do every single day, you will be stunned by the reckless speculation in oil prices, reaching 100 by December, even reaching 200 by next year. This speculation is pushing oil prices higher. Why do we have excess speculation in the oil market? The reason is we have excess liquidity. People have a lot of money. Institutionals have a lot of money. All of those trillions of dollars did not disappear in a black hole. They are chasing assets right now. And when you have inflation, some of the best assets to chase are commodities, including oil, and therefore you're seeing this excess speculation in the oil market. So how will all of this end? As I said before, two scenarios. The Volcker approach, by raising interest rates, crashing the stock market, crashing the real estate market, crashing the commodities market, including oil, by the way, and perhaps creating a global recession. Number two, let inflation be, and we will face either hyperinflation, stagflation, or if we have a hidden accelerator within that stack of risk, it will light up on fire and it will blow up the entire global economy. Both resolutions are dire, and the reason is the madman that we have right now at the helm of the Federal Reserve, Chairman Jerome Powell. Listen to renowned economist Mohamed El-Arian, who says that the inflation call by the Fed is perhaps one of the worst calls in history.
You wrote a scathing piece in the Financial Times this week. I want to start with a quote from it. Failure to act promptly would turn the Fed's increasingly discredited transitory characterization from one of the worst inflation calls in decades to also a big policy mistake with widespread and unnecessary damage. Mohammed, I want to start with that single piece there. One of the worst inflation calls in decades. Why do you think it's this bad?
Because they didn't show humility at the beginning of the process, and that's something that you and I talked about. There are lots of structural changes going on in the post-pandemic economy, even though we're not quite there, but post-immediate shock. You can't simply dismiss them as transitory. You've got to respect the fact that behaviors change. And they just didn't have the open mindset enough to see that. So they got stuck in this narrative, and they held on to it for too long. And the result of which is they're looking at inflation that is much higher than they ever expected. They're looking at inflation that's much broader than they expected. And they're looking at inflation that's going to last even longer than they expect even now. So it is going to go down in history as one of the worst inflation calls by the Federal Reserve.
And when historians look back, what caused the great inflation in the aftermath of the COVID crisis and the events that happened after that? When they look back, perhaps they will look at this, a 60 Minutes interview with Chairman Powell back in April of this year. And here's what he said. So what we've said is that we'd consider raising rates when the labor market recovery is essentially complete. We are back to maximum employment and inflation is back to our 2% goal and is on track to move above 2% for some time. It'll be a while until we get to that place, but that is the guidance that we've offered to the public, the conditions we'd want to see before we start raising interest rates. Sound delusional, isn't it? And the interviewer asked the question, what the Fed has done traditionally is use economic models to predict inflation and then raise interest rates, tap the brake, if you will, before inflation happens, meaning the proactive, not the reactive. Is that what you're planning on doing? Jerome Powell responded, and this is the biggest mistake in the Federal Reserve's history. This answer right here. Powell said, no, it's not. And really, what we have done is we've updated our understanding of the economy and therefore our policy framework to the way the economy has evolved. The economy has changed. What we saw in the last couple of cycles is that inflation never really moved up as employment went down. We've had 3.5% unemployment, which is a 50-year low for much of the last 2 years before the pandemic, and inflation did not really react much. That is not the economy we've had 30 years ago. That is the economy we have right now. That means that we can afford to wait to see actual inflation appear before we raise interest rates. Once again, folks, the mistake of the century. Continuing with Powell, he says, or said in the interview, now we don't want inflation, to go up materially above 2% and go back to, the bad old inflation days that we had when you and I were in college back a long time ago. He's referring to the 1970s, of course. But at the same time, we do have the ability to wait and see real inflation, and that's what we plan on doing. Once again, the biggest mistake in Federal Reserve's history. So if you are looking for somebody to blame for this inflation, look no further than this delusional madman, the chairman of the Federal Reserve, Jerome Powell, his allies, and enablers. Folks, this is all I got for you for now. I hope you found this video helpful, and if you did, return the favor by pressing the like button, subscribing, and sharing the content. Once again, thank you for watching. Thank you for listening. This is all I got for you for now, but we will resume the normal stock market coverage starting tomorrow.